Welcome to the Nighthawk Equity Fund of Funds program. My name is Garrett Lynch, and I'm one of the managing partners at Nighthawk Equity. I'm also the co-host of the Financial Freedom with Real Estate Investing podcast. Since 2017, Nighthawk has done 21 deals and built a portfolio valued at over $350 million. To achieve this, we've partnered with over 400 passive investors. This video is for you if you can raise at least $500,000 as a fund manager through your network of qualified investors and are looking to partner with a high-quality multifamily operator. We're looking for fund managers who are committed to scaling their capital raising and build a profitable long-term relationship. We're dedicated to helping fund managers start and scale their funds. We're not only going to provide a done-for-you setup and ongoing services, but we'll also support you on your capital raising campaign so that you can safely achieve and exceed your capital raising goals. In this video, I'm going to be going over what is a fund of funds, why you should partner with Nighthawk Equity, and the economics of a partnership. So what is a fund of funds? So Nighthawk's fund of funds is an offering that is formed to invest directly into an individual multifamily asset. Its investors are limited partners that consist of individual investors as well as one or more funds. Each fund is a separate entity that's sometimes referred to as a special purpose vehicle, or SPV, that requires its own governing documents. This includes an operating agreement, private placement memorandum, subscription documents, and files for specific exemptions that make it safe and compliant to raise funds for predetermined and familiar private investments. You, as the fund manager, will provide services to your investors for which you are appropriately compensated. For example, you're going to set up the entity. You're going to identify the appropriate asset to invest in. You're going to do due diligence on the investment. You're going to negotiate the best terms for the fund and its investors. You're going to communicate with your investors and provide ongoing fund administration, like distributions and tax services. Unlike other syndications that form co-GP partnerships, the Nighthawk Equity Fund of Funds program allows fund managers to raise capital in a more SEC compliant way, which gives them more security and provides better control of their compensation. So why should you partner with Nighthawk Equity? Well, there are 4 reasons. First is experience. We have a combined 34 years of multifamily operating experience. Next is track record. We've acquired over 3,000 units since 2017 with many successful exits. Next is capital raising. We are very versed in raising capital. We've raised over $95 million from over 500 investors ourselves. We also are really good at operations. We have a full-time corporate staff that manage our assets, oversee construction, and support our investors and fund managers. If you want to learn more about us, visit nighthawkequity.com. So I'm going to talk more about the services that we provide. The first is a done-for-you fund setup administration. So we support you in establishing and managing your fund. This includes legal, tax-related items, and others so that you can focus on raising capital and taking care of your investors. We also provide marketing and sales support. So we're going to support you on your live webinar. We're going to invite you for an on-site visit to help you create your content. We're going to create digital assets to help you save time and money. We're also going to help you with investor relations. So we'll help you with the communications, provide a dashboard with a data room, and send you distributions for you to pass along to your investors. We're also going to provide tax support. So we'll assist you with getting your K-1s to your investors in time and dissolve your fund upon exit. The last thing to discuss is the partnership terms and economics, meaning how much you can project being compensated as a fund manager. So a $500,000 fund minimum is required to receive enhanced economics. The fund manager will create a special purpose vehicle, like we talked about earlier, to invest in a special class of shares. These shares offer better terms than for individuals who just invest in regular Class A shares. The special class shares are designed to yield proportionately higher returns compared to regular Class A shares. So this structure ensures that the fund manager is adequately compensated while also allowing investors to receive returns that are comparable to those of just regular Class A shares. This setup makes the overall economics viable for both parties. So I'm going to go over a quick example. Please note that this is for informational purposes only, not necessarily reflective of an actual deal we would do. But let's say that we have a deal where we're offering regular investors a 6% preferred return and a 70-30 profit share. your special class shares would get higher preferred return, let's say 7% in this example, and would receive a better profit split, let's say 80-20. So in the recommended fund structure, fund manager, first of all, they can structure their fund however they wish. The way we recommend allows fund LPs to earn a similar or better return as compared to investing directly in the parent offering, while the fund manager can target competitive compensation. So a fund manager is going to charge the fund a 2% due diligence fee that's paid at closing. So if they raise $1 million, that's going to be $20,000. Fund manager charges a 0.5 point fund management fee to be paid on an annual basis. So if they raise $1 million, 0.5 point of that would be $5,000 paid annually. The fund manager charges the fund for setup and ongoing administration costs. So their legal, admin, all that stuff, $5,000 up front and then like $2,000 a year, assuming that the fund only has 10 investors or less. The fund manager then offers LP shares at a 6% preferred return and a 70-30 split. Remember, they're getting 7% and 80-20. Fund manager's compensation is derived from the enhanced economics of the special class shares. With this recommended fund structure, the fund manager's on-target compensation is about 9 to 11% of total equity raised over a 5-year projected hold period. So $1 million, if you raise $1 million, let's say for a deal, you can expect to be compensated somewhere between $90,000 and $110,000. The next steps. So if you're committed to scaling your fund and you're looking for a long-term relationship with a high-quality operator, we would love to speak with you more about partnering with us. The next step is for you to complete a short questionnaire and then schedule a call with us. If we decide that there's a mutual fit, we'll work out a letter of intent that spells out how we would structure a deal when we get one. When we have a live deal, we'll finalize the terms and onboard you onto our fund manager platform so that you can start raising capital. So if you're ready to partner with us on our next raise, let's have a conversation. We're excited to share with you further details about how we can support you and look forward to learning about how we can help you best accomplish your goals. Click below to book a call, and we can't wait to speak with you.